And let's move on now with part 2 of today's class. In this part, the course looks at wages and a variety of other income items that are reportable on the 1040. And these topics are covered in greater detail in Pacific Northwest Tax School's courses, wage reporting, fringe benefits, and the foreign earned income exclusion, as well as investment and pass-through income reporting requirements, including FBAR and FATCA. And moving across over to the 1040 form here on the right-hand side of our screen, we're going to begin by taking a look at income that is reported on line 7 of the 1040 return. And of course, that line is used for reporting wage income as well as salaries, tips, and something called et cetera. So a good part of what we're going to be looking at today is what is meant by et cetera. And we're going to begin with this paragraph right here, taxable wages and taxable fringe benefits. On line 7, you should report all employee compensation as income from wages. Employee wages include salaries, tips, bonuses, awards, commissions, allowances, severance pay, sick pay, and the value of fringe benefits. Income from wages received and income from payroll advances for services that are yet to be performed should be reported in the year you received the payment. Now, the federal law provides specific treatment to employee wages, and employee wages are generally subjected to a variety of taxes, including Social Security tax, Medicare, and unemployment tax. And because employee wages are subjected to these taxes at both the employer and the employee level, there is an absolute incentive for employers to try to avoid paying these taxes by giving special benefits to their workers rather than giving them a paycheck. These benefits are referred to as fringe benefits, and while some fringe benefits are tax-free, most are considered to be the equivalent of wages and are taxed at the same rate as if they were wages. So let's take a look at what the IRS defines as a wage. The pay you receive may be paid in the form of cash or in any other form, and wages include salaries, vacation allowances, bonuses, commissions, and fringe benefits. Now, it doesn't matter how the payments are measured or made to you. Your employer should include these payments on your W-2 and withhold income, unemployment, Social Security, and Medicare taxes. And all of the following payments are considered to be wages paid. Amounts an employer pays for you or pays you as a bonus for signing or ratifying a contract in connection with the establishment of an employer-employee relationship. An amount paid to you for cancellation of an employment contract. Payments for you to relinquish your contract rights. Compensation paid to you after you ended your employment if you performed these duties while you were still employed. Taxable fringe benefits. A fringe benefit is a form of pay for the performance of services. Fringe benefits are taxable and must be included in employee pay unless they are specifically excluded from taxation under the law. You generally must include fringe benefits you receive in your income unless the benefits are non-taxable. And following are examples of taxable fringe benefits. Free use of a company car. Flights on aircraft that are provided by your employer. Free or discounted commercial flights. Free vacation. Discounts on property or services. Memberships to country clubs or other social clubs. Tickets to entertainment or sporting events. In general, your employer must include the fair market value of these benefits to the extent that you were not required to pay for these benefits. And the value of taxable fringe benefits is reported in boxes 1, 3, and 5 of your W-2. And there are special rules governing how your employer values certain fringe benefits. Now, the next item we're going to look at that appears on line 7 is tip income. And all tips you receive are income and are subject to income tax. Just because you receive a cash tip on the job does not mean it's tax-free. If you receive tips, you should keep a daily tip record that shows the tips you received. You should report the tips that you received to your employer, and then you should include all tips you received as income on your tax return. Let's talk a little bit about the daily tip record. You can record your tips using either of two methods. Firstly, by writing information about your tips into a tip record. And the other option is to keep copies of documents that show your tips. Examples include restaurant bills, credit card, and charge slips. If your employer uses an electronic tip record, you must receive and keep a paper copy of it for your records. So why should you report your tips to your employer? Well, you're required to under the law is the first thing, but there's other reasons as well. If you report your tips as you're supposed to, your employer will be able to withhold income, Social Security, and Medicare taxes. Also, your employer can correctly report your earnings to the Social Security Administration and to avoid the penalty for not reporting your tips as the law requires. Now, if you are not reporting tips as the law requires, it could be that you end up having tips allocated to you on your W-2. In certain instances, it's possible that even though you are properly reporting your tips, you still get an allocation on your W-2. And for both those reasons, you need to keep a tip log to be able to agree with or dispute any tip allocation that appears on your W-2. Allocated tips are amounts that your employer assigns to you in addition to the ones that you reported. Your employer is required in certain situations to allocate tips to you if you fail to report tips totaling 8% or an approved lower rate or more of your food and beverage sales. If your employer allocates tips to you on your W-2, you must report these allocated tips on your tax return. You should include Box 8 allocated tips with other wage earnings that you report on your tax return. Now, if you disagree with the allocated tips that your employer assigned to you in Box 8, you can dispute the allocation if you keep a tip record. If you keep a tip record, you should include the amount of tips that you actually received, but do not report to your employer as wage income on line 7 of Form 1040. So in other words, when you complete your tax return and you have income reported on a W-2 from an employer where you also receive tips, you would include all income reported on that W-2 on line 7. If the W-2 also shows allocated tips, whatever amount of allocated tips you received, you should also add to line 7, and unless, of course, you can show that you didn't get those tips with a tip log. Next item we're going to talk about that is also entered on line 7 is taxable scholarship and fellowship income. A scholarship or fellowship can be tax-free, but it is only tax-free if you are a candidate for a degree at an eligible educational institution and you use the scholarship or fellowship to pay qualified educational expenses. A scholarship is not taxable to the extent it is used to pay qualifying expenses. The following expenses are qualified educational expenses: tuition and fees required to enroll at or attend an eligible educational institution, and course-related expenses such as fees, books, supplies, and equipment that are required for the courses at the eligible educational institution. These items must be required of all students in your course of instruction. But expenses that do not qualify as tax-free and are therefore a form of taxable scholarship include the value of room and board, or amounts that you receive to pay for room and board, amounts paid for travel, research, clerical help, or equipment and other expenses that are paid for through the scholarship but are not required for enrollment in or attendance at that eligible educational institution. If you receive a taxable scholarship or fellowship, you report that amount on Form 1040 or on 1040A on line 7, and if the amount was not reported on a W-2, you would enter SCH in the space provided on line 7. And you literally, if I can get this typed in here, you type SCH on line 7, and then you include the scholarship amount in the amount that you actually enter on line 7. Next up are taxable refunds. So we're moving on to line 10 of the tax return. Generally, you must report your state refund as federal taxable income, but only if you itemized your deductions for the year on which that refund is based. Additionally, you must have derived a tax benefit from claiming state taxes paid as an itemized deduction. So let's talk a little bit about this tax benefit rule. A refund is only taxable if you received a tax benefit from deducting it in a prior year. That is, you were able to reduce your tax liability for the year that you claimed the deduction because you claimed state taxes paid as an itemized deduction. Is there a time when your federal refund is taxable? Well, at the federal level, your federal refund would never be taxable. Refunds of federal income tax are never included on your federal income tax return because federal taxes are not deductible on the federal return. Now, in certain situations, your federal refund might be taxed by the state. You should research the tax laws specific to your state to determine if and when your state might tax a federal refund. And we do cover taxation of federal refunds in our Oregon courses. Taxability of state income tax refunds. If you claimed a deduction on a prior year return for taxes you had withheld or paid to a state, then you must claim any subsequent state refund as an income on your federal return to the extent you benefited from deducting the state tax refund on your federal return. State governments will issue Form 1099-G to report refunds paid, and typically a 1099-G is only issued if you itemize deductions, but I have frequently seen it issued even when itemized deductions were not claimed. So a 1099-G could be an indicator that a refund received from a state is taxable, but the receipt of a 1099-G does not in fact mean that it is certainly taxable. You would need to determine if it's taxable by determining if the person itemized in the year for which that refund is allocated and whether or not there was a tax benefit because of that itemization. And the next item we're going to take a look at is alimony, reported on line 11 of the 1040. Alimony is also called spousal support. If your former spouse pays you alimony under a divorce or separation instrument, you must include any payments you received during 2015 as income on your 2015 return. You report alimony or spousal support you received on line 11, and if you pay alimony, you may be able to claim a deduction on Form 1040, line 31 instead. So if you pay alimony and you meet the definition of alimony, you can claim a deduction for it on line 31 of your return. If you receive taxable alimony, then it is entered on line 11 of your tax return. To be alimony, a payment must meet certain requirements. To determine if the alimony payments you receive are taxable, all of the following rules must apply. The payments are required by a divorce or separation instrument. You cannot file a joint return with the spouse who is paying you the alimony. The payment is in cash. Your divorce or separate maintenance decree does not state that the payment is not alimony. You and your former spouse who are paying the alimony do not share the same household. There is no liability to make any payment in cash or property after the death of the recipient spouse, and the payment is not treated as child support. You cannot report alimony received on Form 1040-EZ or 1040-A. Next up, we're going to talk about line 19, bumping down here, which is where unemployment compensation is reported. Generally, any unemployment benefits you receive are taxable on your federal return. If your unemployment benefits are taxable, the state paying the benefits should issue a Form 1099-G reporting the benefits paid to you. You should enter the taxable unemployment benefits that you received as they are shown on the 1099-G, on line 3 of 1040-EZ, line 13 of 1040-A, or on line 19 of the long form 1040. Now, if you repaid any of your 2014 unemployment benefits during 2015, then you should subtract the amount that you repaid from the amount you received and enter the net amount on your 2015 return. On the dotted line next to your entry, you should write repaid in the amount you repaid. If during 2015 you repaid unemployment benefits that you received in a prior year, you can deduct the amount that you repaid as an itemized deduction on Schedule A, line 23, if you itemize your deductions. And you can learn more about this by reading IRS Publication 17 on page 93 under Repayment of Unemployment Compensation. Gambling winnings, we're moving on now to line 21 of the Federal 1040 return. Gambling winnings are taxable, and you must include all of your gambling winnings as income on Form 1040, line 21. You will be issued a Form W-2G if you receive any of the following: $1,200 or more in gambling winnings from bingo or slot machines, $1,500 or more in proceeds, that is the amount of wins minus the amount of wagers from Keno, more than $5,000 in winnings reduced by wager or buy-in from a poker tournament, $600 or more in gambling winnings except winnings from bingo, Keno, slot machines, and poker tournaments, and the payout is at least 300 times the amount of the wager, or any other gambling winnings subject to federal income tax withholding. If you itemize your deductions on Schedule A, you are allowed to deduct gambling losses that you had during the year, but only to the extent of your gambling winnings. Also reported on line 21 is canceled debt, if that debt is taxable canceled debt. If you borrowed money and that debt was canceled, you must generally report the amount of canceled debt as income on your tax return. You can learn more about canceled debt in IRS Publication 4681, Canceled Debts, Foreclosures, Repossessions, and Abandonments. That publication provides detailed instructions on various types of canceled debt and how to calculate the amount of taxable income that applies to different types of canceled debt. If you have canceled debt that is taxable, then it is likely the case you will be issued a 1099-C. If you are the borrower and your debt was reduced or eliminated, you should receive a year-end statement on Form 1099-C from your lender. For debt canceled in 2015, the lender is required to provide this form to the borrower by January 31, 2016. And by law, this form must show the amount of debt forgiven and the fair market value of any property that is given up through foreclosure. The IRS urges borrowers to check the Form 1099-C carefully and to notify the lender immediately if any of the information shown upon it is incorrect. Borrowers should pay particular attention to the amount of debt that is forgiven in Box 2 and the value listed for a home, if it is a foreclosure on a home, in Box 7. Interest and dividend income on Form 1040, lines 8 and 9. Investment income generally includes interest, dividends, royalties, annuities, and short-term capital gains. And much investment income, but not all, is reported on Schedule B. So let's talk about that form for a little bit. Depending on the amount of interest and or dividends that you received, you may be able to report your interest and dividend income directly on Form 1040 on either line 8A or line 9A, or line 8B or line 9B. Or you may need to complete Form Schedule B first. You are required to attach Schedule B to your tax return if your taxable interest or ordinary dividend income for the year is more than $1,500. You are excluding interest under the Education Savings Bond Program. You had a foreign bank account or trust. A homeowner paid you interest under a seller-financed mortgage. You received Form 1099 INT for U.S. savings bond interest for amounts you reported before 2014. You received nominee interest or ordinary dividends for someone else. You received a Form 1099 INT for interest on frozen deposits, or you are reporting original issue discount in an amount that is less than the amount shown on the Form 1099 INT. Next item we're going to look at is interest income, and of course interest income is reported on the interest line and where necessary on Schedule B. Income you receive from money you leave on deposit in a bank or credit union or from money that you loan to others is interest income. Money market mutual funds also pay interest income. Dividends that are actually interest. You should note that so-called dividends from deposits that you have with credit unions or savings and loans are actually interest and should be reported as interest income, even though those institutions will refer to them as dividends. Gift for opening an account. If you receive a gift from a bank valued at more than $10 and you have less than $5,000 on deposit, then you must include the gift as interest income. For deposits of $5,000 or more, you must report as interest income gifts of more than $20. So if the amount you have on deposit is $5,000 or more, then you are only required to report interest income if the gift is worth more than $20. Interest on insurance dividends. Interest on insurance dividends left on deposit with an insurance company that can be withdrawn annually is taxable to you in the year it is credited to your account. However, if you can include it only on the anniversary date of the policy, then the interest is taxable in the year that that date occurs. Prepaid insurance premiums. Any increase in the value of prepaid insurance is interest income if it is applied to the payment of premiums that are due on the insurance policy. Interest on U.S. government obligations, including U.S. Treasury bills, notes, and bonds. U.S. government interest is reported in Box 3 of Form 1099 INT, and there are two important facts that you do need to remember about U.S. government interest. Firstly, it is not taxable at the state level. If you are filing a state tax return, the amount of interest shown in Box 3 of the Form 1099 INT could be a subtraction on your state return. It just depends on how your state return talks to the information appearing on the federal return. Also, you may be able to exclude U.S. government interest income if you paid qualifying educational expenses during the year. To see if you qualify for this particular exclusion, you should see the instructions for Form 8815. but the married filing separate status does not qualify for that particular exclusion. Installment sale payments. If you sell your property on a contract to receive payments over time, then you have an installment sale. If you fail to provide written terms for the interest amount of a contract sale, then the interest portion of each payment will generally be implied. Interest is taxable when you receive it, and in other words, you cannot choose to give an interest-free loan. State or local government obligations. Generally, interest on obligation used to finance government operations is not taxable on your federal return if the obligations are issued by a state or local government. Individual state laws determine whether the state or local bond interest is taxable by the state. In general, a state will not tax its own bonds, but will tax interest income from bonds purchased from other states. Oregon, for example, taxes California and Washington state interest, but does not tax Oregon state bond interest or interest on Puerto Rico bonds. If your taxable interest is $1,500 or less, you are allowed to report it directly on Form 1040A, 1040A, or 1040. If your interest income is more than $1,500 or your interest income is subject to special treatment or you have a foreign financial account, foreign bank account, you must report your interest income on Schedule B for 1040A or 1040. And 1099 INT, this is a reporting document that will be issued to you if you earned $10 or more of interest from the money you have invested in the bank from any one financial institution. It is sometimes the case that financial institutions will issue a 1099 INT even when the amount is under $10, but it's frequently the case that if the amount of interest that a client received for the year is under $10 for the year, that the bank will not issue that document. Next in line is line 9 of the tax return, which is used to report dividend income. Dividends are paid to shareholders of corporations, and dividends are the shareholder's share of the corporation's profits. There are 3 types of dividends: ordinary and qualified dividends, capital gain distributions, and non-dividend distributions. If you are looking at a 1099 DIV, you would look to boxes 1A and 1B to see ordinary and qualified dividends that are being reported. That same document would report capital gain distributions in box 2 and then non-dividend distributions in box 3. You will receive Form 1099 DIV if you had $10 or more of dividends during the year from the company that is required to issue you the document. Dividends you receive from your insurance policy that are a return of premiums or are used to pay premiums are not taxable until they exceed the total of all net premiums you have paid. However, if you receive interest payments on these dividends, then that interest is taxable as interest income. And then we're going to look at nominee interest and dividends. If your Form 1099 DIV or Form 1099 INT includes amounts that really belong to another person, then you are considered to be a nominee recipient, and you should report the full amount of interest or dividends that are reported on the 1099 DIV or INT on your Schedule B. You then total all of the interest and dividends that you are reporting for the year, and then on a separate line below, on the Schedule B, you would actually subtotal out and enter the amount of nominee distribution that you are transferring to the party to whom that income actually belongs. So you claim a deduction off of your income on Schedule B, and then you nominee that income over to the person who is required to report it on the return. But in addition to that, you must file Form 1099 DIV or Form 1099 INT with the IRS for each year the other owner of the income or for each other owner of the income that you are nomineeing over. But a husband or wife is not required to file a Form 1099 INT to show amounts owned by the other. Now, one of the areas that the IRS has placed increasing focus on over the last few years are reporting requirements for foreign account holders. If you have interest in or control over a foreign financial account or trust, you may be subjected to additional disclosure and reporting requirements, including you must file Form 114 with FinCEN if the aggregate value of all foreign financial accounts you have exceeded $10,000 at any time during the calendar year reported. And U.S. taxpayers with special foreign financial assets that exceed certain thresholds must report these assets to the IRS. This reporting is made by attaching Form 8938 to your tax return. So we're going to talk a little bit about each of these here today. Firstly, FinCEN Form 114. Title 31 FBAR requires U.S. persons to report interest in non-U.S. bank and financial accounts to the Financial Crimes Enforcement Network, or FinCEN, on Form 114, Report of Foreign Bank and Financial Accounts. Foreign financial accounts include the following: bank accounts such as savings accounts, checking accounts, and time deposits; security accounts such as mutual funds, brokerage accounts, and securities derivatives or other financial instruments accounts; accounts where the assets are held in a commingled fund that is a mutual fund; any other accounts maintained in a foreign financial institution or with a person who is doing business as a financial institution, for example, a foreign retirement account. Foreign financial accounts do not include the following accounts: individual bonds, notes, or stock certificates that are held by the filer, and unsecured loans to a foreign trade or business that is not a financial institution. So let's take a look at the filing requirements for FinCEN 114. You must file this report if your non-U.S. financial account holdings totaled more than $10,000 at any time during the preceding year. The report must be filed annually on or before June 30th of the year following the calendar year that is being reported. You must file FBAR using FinCEN 114 if you are a U.S. person and you had a financial interest in or a signature authority over at least one financial account located outside of the United States and the aggregate value of your foreign financial accounts exceeded $10,000 at any time during the calendar year to be reported. A United States person includes U.S. citizens, U.S. residents, entities, including but not limited to corporations, partnerships, or limited liability companies that are created or organized in the United States under the laws of the United States, and trusts or estates that are formed under the laws of the United States. For example, if your non-U.S. financial accounts totaled $11,000 in 2014, you would need to file FBAR using FinCEN 114 not later than June 30th, 2015. The report must include the name and address of each foreign financial institution where you have accounts, and you must also provide account numbers and account balances for each account that you held during the year. There are some exceptions to the FBAR filing requirements. Not every type of account needs to be reported, and not everyone needs to report all accounts. There are filing exceptions for the following U.S. persons or foreign financial accounts: certain foreign financial accounts that are jointly owned by spouses, United States persons included in a consolidated FBAR, correspondent or nostro accounts, foreign financial accounts owned by a government entity, foreign financial accounts owned by an international financial institution, IRA owners and beneficiaries, participants in and beneficiaries of tax-qualified retirement plans, certain individuals with signature authority over but no financial interest in a foreign financial account, trust beneficiaries, and foreign financial accounts maintained in a United States military banking institution. The FBAR instructions provide additional information to determine the eligibility for an exception and exception requirements. Extension of time: well, there is no extension of time to file FBAR. If you file the report late, use the online system's drop-down menu to explain the reason that you are filing the report late. We're going to take a look now at line 13 of the Form 1040. This is where capital gains and losses are reported. And when you report capital gains and losses, you will use Schedule D, and very often you will also use 8949. Schedule D was significantly changed for 2011 and later years. Many transactions that in previous years would have been reported directly on Schedule D must now be reported on Form 8949 instead. You complete Form 8949 before you complete lines 1, 2, 3, 8, 9, or 10 of Schedule D. Use Schedule D to figure the overall gain or loss from transactions that are reported on 8949, as well as to report certain transactions that do not need to be reported on 8949. Schedule D is also used to report a gain from Form 2439, Notice to Shareholder of Undistributed Long-Term Capital Gains, Form 6252 for installment sales, or Part 1 of Form 4797, sale of business property. To report a gain or a loss from 4684, casualties and thefts, Form 6781, gains and losses on Section 1256, contracts and straddles, or Form 8824, like-kind exchanges. You also use it to report the gain or loss from a partnership, S corporation, estate, or trust, and to report capital gain distributions that are not reported directly on Form 1040, line 13, or effectively connected capital gain distributions that are not directly reported on Form 1040 NR, line 14, as well as to report a capital loss carryover from an earlier year, and to report transactions for which basis reporting on 1099B is correct. Aggregate reporting of stock sales. You may be able to aggregately report sales directly on Schedule D rather than on Form 8949, beginning with tax year 2013 and later years. Effective 2013, Schedule D now makes provision for aggregate reporting of capital gains and losses rather than reporting each sale individually, as was previously required. The following rules must be applied when aggregate amounts are reported directly on Schedule D. Firstly, the aggregate reporting is allowed only where the basis amounts reported on Form 1099B are shown correctly, and in cases where the basis is not correctly reported, the transactions must still be reported on Form 8949. Form 8949 is the document used to report sales and other dispositions of capital assets, and most sales of property are not reported directly on Schedule D. Form 8949 is used to report sales and exchanges of capital assets, and the form allows you to reconcile amounts that were reported on Form 1099B or 1099S or a substitute statement with amounts that are shown on your return. And here are the reporting rules for Form 8949. The form is used to reconcile amounts reported to the IRS with amounts reported on your tax return. It's therefore important to match entries on Form 8949 to the amounts reported to the IRS on Forms 1099B and 1099S. You use Form 8949 to report sales and exchanges of most capital assets, including stocks, bonds, and real estate, except where these sales were reported on 4684, 4797, 6252, 6781, or 8824 instead. You include transactions on Form 8949 even if you did not receive a 1099B or a 1099S for the transaction. You report short-term gains or losses in Part 1 of the form, and long-term gains or losses are reported in Part 2 of the form. You enter the details of each transaction on a separate line of Form 8949 and use as many forms as you need. Treatment of capital gains and losses. If your capital losses are more than your capital gains, you are allowed to deduct your allowable losses against other taxable income. However, there is a yearly limit on the amount of capital loss that you are allowed to deduct. It is $3,000 for all filing statuses except married filing separately, which is half that amount. If your capital losses are more than your capital gains, or rather exceed $3,000, any losses that are in excess of $3,000 can generally be carried forward until the next year. Short-term and long-term losses. When you carry over a loss, it retains its original character as either short-term or long-term. A short-term carryover to the next tax year is added to net short-term losses that occur in that year, and a long-term loss carryover to the next year is added to net long-term losses occurring in that year. If you have both short-term and long-term losses, your short-term losses are used first against your allowable capital loss deduction, and then if after using your short-term losses you have not reached the limit on the capital loss deduction, you will use your long-term losses until you reach the limit. And of course, a long-term loss or a long-term gain occurs when you dispose of property that you held for more than 1 year. A short-term loss occurs when you dispose of property held for 1 year or less. Comprehensive illustration. I figure that the best way to really pull together all of the rules that we've been talking about today is to just put them on a tax return. Create a tax scenario and make sure that that tax scenario includes a great deal of what it is that we've been talking about today. And so I created an illustration for our course on reporting capital gains and losses, and I've included that particular illustration from that course in this course today. Now, the forms required for the illustration include 1040, a Schedule A, a Schedule B, a Schedule D, an 8938, an 8949, and FinCEN Form 114. Now, at the time we are publishing this course, which is July of 2015, 2015 tax forms are not available, not even draft forms at this point. And so this entire illustration is put together using 2014 forms. And of course, when the 2015 forms are released, we will update this particular problem, but you can refer to the updated forms as they are released by the IRS and kind of figure through how this assignment would transfer over, and it is likely there would be very few changes in how it transfers over to the 2015 forms. So let's take a look at our character. His name is Jake Edwards, and he is married to Mary, who is a homemaker. Jake is an engineer at Intel Chip Company, and during the year he sold non-qualified stock options. The sale of the options was reported through UBS Financial Services, and Jake's UBS Form 1099-B, his UBS Intel Advice of Exercise, and his W-2 are attached. Jake inherited stock from his father, who was a resident of the United Kingdom. His stock remains invested in Barclays of London. The year-end value of the account was £100,000, and the maximum value of the account during the year was £125,000. The US dollar UK pound sterling exchange rate for the year is 0.6410, which means the maximum value during the year was $195,008 US, and the account issued £6,173 in qualified dividends, which equates to $9,630 US dollars. He did not sell any of his shares during the year. Jake also maintains a savings account with UK National Bank. The account generated $500 of interest income during the year. The year-end balance and the highest balance of his account was $15,000 US for the year, and Jake paid £64 or $100 of foreign tax to the United Kingdom on this interest income. Mary also received a 1099 INT from U.S. Bank, and it reported $1,500 of Box 1 ordinary interest income from the year. The Edwards sold stock and property during the year in the following transactions. They sold some stock holdings through Edward Jones. Their consolidated 1099 statement is included for use in preparing the return. They also sold Intel stock options that were acquired by Jake through an employee stock option plan. An advice of exercise notice issued by Intel is included along with a substitute 1099-B statement from UBS. They also sold some vacant land which was purchased on 1/1 of 99. The land had an adjusted basis of $20,000 and was sold on 10/3 of 2014 for $100,000. They have a long-term loss carry forward of $5,000 from 2013. So let's take a look at the tax documents that were issued to Jake Edwards. And the first of these is the 1099-S document. It reports the sale of the land. And the amount shown in Box 2 of this Form 1099-S will need to be reported on Form 8949 in Part 2 with Box F checked because it is a sale that was not reported on a 1099-B. And the amount that we're going to report as gross proceeds will, of course, be $100,000. We want to see a match between the amount shown on the 1099-S and the amount being reported as gross proceeds on the 8949. Underneath that, we have Jake's W-2, and the key thing of interest on his W-2 is this code V in Box 12, $3,621. This is income from the exercise of employee stock options. $3,621 of income was received from the exercise of those options, and that amount of income has been bumped up on his W-2 as taxable wages. And to the extent that his wages have been bumped up by this taxable benefit, he is going to have an increase in basis or an increase in cost in the shares he holds in Intel. The next document we have is his consolidated 1099 statement, and you can see that it is including 1099 INT, 1099 DIV, and 1099B all in a single document. And let's take a look at the types and amounts of income that are being reported on here. We can see that he has Box 1 interest income in the amount of $1.42, and Box 1 interest income is reported on line 8A of the 1040. He also has tax-exempt interest totaling $1,512.50. This is tax-exempt interest, and it is entered on line 8B of the 1040. We move over then to the 1099 DIV, and we see that he has ordinary dividend income of $3,282. That gets reported on line 9A of his 1040, and on line 1B, he shows qualified dividends of $960, which would carry to line 9B of his 1040 form. He also has capital gain distributions in the amount of $3,669. If this was the only form of capital gain income he had, he would be able to carry that capital gain over and enter it directly on line 13, and then check the box on line 13 to indicate that Schedule D is not required. However, he is required to file Schedule D, so he will not check this box and he will not enter the amount directly on line 13. Instead, he's going to carry the $3,669 of capital gain distributions and include those on Schedule D, line 13. Next in line, we have tax-exempt dividend income. That's $1,578. And this also is included in the amount that he reports on line 8B of the 1040. And then you can see that we have box 11 here, specified private activity bond interest dividends, $117. This is only relevant for taxpayers who are subjected to the alternative minimum tax. Jake is not subjected to that tax, but if he were, then the amount shown on box 11 would be reportable on the form 6252. In this case, we do nothing with the number because 6252 is not required. The next page we have here is proceeds from broker and barter exchange transactions. And you can see here I've highlighted in yellow the short-term transactions for which basis is reported to the IRS. Report on Form 8949 in Part 1 with Box A checked. That's simply telling you where this particular income gets reported. You can see that we have two sales here. And the total of these two sales, one being $10,425, the other being $9,197, these two sales total $19,621. And these amounts are going to carry to line 1A in column D of his Schedule D. The reporting of the stock sale and the cost basis is accurate, so there's no need to carry these numbers individually to his 8949. Instead, he's going to aggregately report the totals on his Schedule D. Next in line, we have his 1099B that shows long-term transactions for which basis is reported to the IRS. Report on Form 8949 in Part 2 with Box D checked. And we can see here that we've got a long-term sales total from Calvert tax-free and also Franklin, Oregon tax-free. The total or aggregate total of these sales is $11,356. But if you look over at this sale right here for $10,053, you will see a code W appearing with an adjustment of $6.25. This means that the basis reported to the IRS is incorrect. We have a wash sale here, and because there is a wash sale being reported on this 1099B, aggregate reporting will not be allowed, and Form 8949 will need to be completed, and each of these transactions will need to be included. Now, we do see that we have various acquisition date, but we have a date of sale where both dates of sale on these shares were the same, and therefore these two sales of $856 and $10,053 can be lumped together and reported as a single transaction, but they will need to be separately reported from the Calvert tax-free transaction. Password number 2 is Dolphin, D-O-L-P-H-I-N. Dolphin. The next in line we have is long-term transactions for which basis was not reported to the IRS. Report these on Form 8949 in Part 2 with Box E checked. We have a single transaction, Calvert tax-free. And the amount of the gross proceeds is $30,148, and the cost basis is $31,548. There's no adjustments that need to be made to these numbers, but because the basis was not reported to the IRS, they need to go on 8949 with Part 2 with Box E checked rather than with Box D checked. Next in line, we have some totals. This is a 1099B total statement. There's no guarantee that any client is going to come in with such a document. However, this particular client does have a document that is showing the long-term totals and the short-term totals. And these can be helpful for reconciliation purposes because one of our jobs as a tax practitioner is to actually reconcile the amount reported on Schedule D with the amounts reported on the 1099 documents. And these reconciliations can make it possible to do that, or make it easier to do that. Then moving along, we have a document that says it is not a 1099 statement, but rather it is a summary of the income that was received during the year. And it's showing, for example, tax-exempt interest income, who paid it, and when it was received. These numbers can be relevant for purposes of preparing the state tax returns. If you have a client who was a multi-state resident during the year, in other words, they moved from one state to another, it may be necessary to use these payment dates to divide interest between where they were living at the time. You also use this information to identify which state the tax-exempt bond interest is from, and depending on where that interest is from, it may or may not be taxable on the state return. So Edward Jones, in this case, has provided these summary statements to help document how it calculated the amounts shown on the Form 1099 INT and 1099 DIV. And your job as a tax practitioner is to really go through and see whether any of this information is relevant. For Jake Edwards, I would say it would be specifically relevant to his state tax return. We're assuming he is a full year resident of the state for the entire year. Would his state be taxing any of this tax-exempt interest? Well, let's just take a look at the state he's a resident of. I don't rightly remember that firsthand. We've made him a resident of California. So let's then take a look at what this exempt interest reporting means for California. You can see that we have American High Income Trust Fund, regular dividend income, and then we move over and look at the tax-free income, Calvert tax-free long-term, and it's a revolving account. We really can't tell by looking at this whether it's going to be tax-exempt on California, and more research would need to be done. But when I go over to the tax-exempt interest up here, I see Boulder, Colorado, and Jefferson County, Colorado. That's definitely not California state bond interest, but he is a resident of California. So what I can tell by looking at these amounts shown here is that he is going to have an addition on his California return for this tax-exempt interest because it is on income from states other than the state of California. And continuing on, we have another document. This document is from UBS Financial Services, and this particular document is showing the exercise and sale of his employee stock options. They're from Intel Chip. It shows the date acquired, the date sold. They're actually bought and sold on the same day, a simultaneous same-day sale. It shows the proceeds from the sale were $13,115, and the cost or other basis of these shares is $9,500. Now, just a moment ago, I showed you Jake's W-2, and on that W-2, I showed you that he had $3,621 of taxable wage that was included on his W-2. And that $3,621 is going to add to the $9,500. Therefore, the amount shown on this document has incorrect basis reporting, and it means that the sale is going to need to be reported on Form 8949 in Part 1 because it's a short-term transaction, but we're going to check box B because the basis reported on this document is incorrect. I should also point out that it is now the case, at least for tax year 2014 and presumably for future years as well, that when there is an increase in basis due to an employee stock option, because that income was included in the employee's W-2, IRS is specifically instructing that the 1099-B not reflect that increase in basis. So as tax practitioners, we should be very much on the lookout for same-day sales of employee stock options where there is a significant amount of gain from that same-day sale. Really, most same-day sale transactions are a wash or a slight loss, and any kind of gain should be triggering your caution flag saying, hey, is there really income here or not? Now, in the case of Jake Edwards, he has been issued this advice of exercise through his employer. It's showing him the grant price, which is the amount he was required to pay for his options, and then the actual total amount. So there's the cost per share, and then there's the amount he paid for the shares that he acquired, 500 shares. It also shows what the fair market value was and the sales price and the total sales proceeds. And you can see the difference between what he had to pay, $9,500, and the total sales proceeds, $13,121, is the total gain that he had. And this total gain is the amount that was included in his W-2, and which is why his cost basis in the shares is actually going to be $13,120 and not the $9,500 that is actually showing on his 1099-B. So moving over to his tax-free return, we begin on line 7 by entering the wages that are shown on his W-2. We add up his interest and enter that. We add up his dividends and enter that. In both cases, we need to complete Schedule B. So let's go over to the Schedule B and see where these numbers came from. And on Schedule B, we show Edward Jones $2, UK National Bank $500 for an interest subtotal of $502. And then we have Barclays of London. That was $9,630. I just told you about that income in the wording of the problem. You had to remember to pull that information out and put it on the return. And then the other dividend income comes off of the Edward Jones statement. Remember that the amount shown on Schedule B represents the ordinary dividend income he received, and he's going to need on the 1040 on line 9B to enter the amount of qualified dividends that he received. And he received qualified dividends from two sources. One is Barclays of London, and the other qualified dividends he received are $960 right there on his consolidated statement from Edward Jones. So the next document we're going to look at is his Schedule D, and you will recall that he did have two different short-term sales where the basis reporting was correct, and so he is allowed to aggregately report those two transactions on line 1A of his Schedule D. But all of the other sales that he had for the year do require reporting on Form 8949 first. So let's go over to Form 8949 and take a look at that. Okay, so we're now looking at Form 8949 where it shows Box A, short-term transactions reported on Form 1099-B showing basis was reported to the IRS. The Intel short-term stock option sale was reported to the IRS with basis included. In other words, basis was also reported to the IRS, but the basis that was reported was the wrong basis, and therefore we need to complete Form 8949 to tell the IRS that there is an adjustment to the gain or loss. So we report the sale in Part 1 of the form, we check Box A, and then we enter the gross proceeds from the sale as they appear on the 1099-B, $13,115. We show the cost basis as it is shown on the 1099-B at $9,500. Then in column F, we enter code B to indicate that the basis reported was incorrect. We enter the amount of adjustment to gain, which is a downward adjustment of $3,621. That's a match to the upward adjustment on his W-2, and that results in him having a net loss of $6 rather than the gain that was showing on his 1099-B. The next form we look at is Form 8949 Part 2, which is used to report long-term transactions. Firstly, we're going to show those transactions for which basis was reported to the IRS, and there are three separate sales for which basis was reported to the IRS. But because one of these sales was a wash sale, the basis reporting was actually incorrect. And so we're entering that adjustment to the wash sale. It's an upward adjustment to the loss, or you could say a downward adjustment to the loss. It's a reduction to the loss. Then the total of the amount shown on line 2 would, of course, carry over to Schedule D and be entered on line 9 of that form. Next up, we have the 8949, where we have Part 2, long-term transactions, where the transactions were reported to the IRS, but no basis was reported. Here we have a single sale of 1,960 shares of Calvert, and it shows various acquisition date, a single sales date, the proceeds, the cost, and a gain of $1,400. And then finally, we have Part 2, long-term transactions, where no sales amount was reported on a 1099-B. The sales amount was reported on a 1099-S, but you can see here specifically it's saying long-term transactions that were not reported on a 1099-B. On this line, we enter the description, which is vacant land. We enter the proceeds from the sale. We enter the cost basis and the overall gain. Once we've completed all necessary Form 8949s, we move back over to the Schedule D, and on the Schedule D on line 1B, we enter the amount shown on Form 8949, Part 1 with Box A checked. We enter in Part 2 on line B the amount shown on 8949, Part 2 with Box D checked. Then on 8949 with Box E checked, and finally on 8949 with Box F checked. On line 13, we show the capital gain distributions that were reported on his 1099 DIV. And just to remind you where those were, let's go right back up to that 1099 DIV. We talked about it earlier. It shows the amount of capital gain distributions in Box 2A, $3,669. That carries to the Schedule D and is entered on line 13. We then have total long-term capital loss carryover. In the wording of the problem, I told you that there was a $5,000 carry forward from 2014. That loss is entered on line 14. And then the net long-term capital gain or loss is $76,086. We add up all of the amounts shown here on line 7 through 8, 9, 10, 13, and 14, and when we're finished adding those up, we get $76,086. We then move on to page 2 of the form, and on page 2 of the form, we show that the net gain or loss for the year is $74,232. That is $76,086 of long-term gains reduced by the short-term loss that is shown in Part 1 of the Schedule D. Now, once we've entered the net long-term capital gains on line 13 of the form, it's time to add up his adjusted gross income for the year. It's $216,267. That carries to line 38 of the form. He then prepares a Schedule A to report his itemized deductions, which were pretty basic, and claim the exemption deduction for himself and his wife. We end up with $194,411 of taxable income, and this is the point at which we need to do a worksheet to compute the amount of tax that will be entered on line 44. So let's go take a look at the worksheet that's been prepared for them. And here is the worksheet. We begin on the worksheet by entering the taxable income shown on his Form 1040. And from that point, we begin to pull out relevant numbers. On line 2, we enter the qualified dividend income shown on line B of his 1040. On line 3, we enter the capital gain income from Schedule D. And on line 4, we add these numbers together, $84,822. This is the total amount of capital gain income that is going to be allowed or is eligible for the reduced capital gain rates. We're going to subtract the capital gain income from his overall income, and when we do that, we get $109,589. This is the amount of ordinary income that he has. And the next step on line 24 is to enter $19,110. This is the income tax owed by the Edwards on the ordinary part of their income. Next, we look to see where their income falls. Their income is definitely above $73,800, which is the amount that the form says to enter for married filing joint. Because their income is higher than that number, they're not eligible for the 0% capital gain rate. We also look to see what their filing status indicates for the high end of the capital gain spectrum, and that's $457,600. If the income of the Edwards was above this number, then their capital gains would be taxed at 20%. But because their income is greater than $73,800 and less than $457,600, all of their capital gain income is going to be taxed at a rate of 15%, which means we take $84,822, we multiply that by 15%, and we get $12,723. We add $12,723 to the tax we computed on $109,000, which was that $19,110, and it's shown right here on line 24. When we add those numbers together, we get $31,833. The next step is to see what the ordinary tax rate would be based on their capital gain income and their ordinary income, all being taxed at ordinary rates. That amount of tax would total $41,682, but he is eligible for the lower capital gain rate, and so ultimately $31,833 is the amount that will carry to the 1040, and that is the amount you see entered here on line 44. Next, we show that he did have full year health insurance coverage, so there's no extra tax he has to pay on line 61. We show his total tax at $31,833. He had withholding of $32,155, and he is due a refund of $322. Now, we're not done. Because he has more than $50,000 of financial holdings overseas, he's going to need to file a couple of extra forms. One of these forms is 8938, and on the form 8938, he reports the total value of his foreign financial holdings. The maximum value of all of his deposits is totaled right here. You can see we've got Barclays of London and the UK National Bank. They total $210,088, and we've carried that down and entered it on line 2 of form 8938. Then in Part 3, we show where on his tax return the income from these holdings is being reported. And we're showing that he had $500 of interest income being reported on line 9A and on Schedule B, line 1, and that he had $9,630 of dividend income being reported on line 9A of his Federal 1040 as well as on line 5 of his Schedule B. We then move to Part 5 of the form where we provide information about the exchange rate the amount of foreign financial holding he has in a particular account, and it continues on next page of the Form 8938 where he enters the name of the financial institution. We're not done. He also has to fill out a continuation sheet to show similar information on the UK National Bank holdings that he has. And after we're finished with Form 8938, we're still not done. It's time to fill out his FBAR report, or his FinCEN Form 114. And on Form FinCEN, we report his personal information to identify himself. And then we move on, and in Part 2, we report the accounts that he held. There are 2 accounts. The information for these accounts is similar to what we saw in Form 8938. We report that information, then it is submitted electronically to FinCEN. So that concludes Part 2 of today's class. What you're going to need to do at this point is to pause video playback and complete some review questions, and then you'll be ready to move on to Part 3 of the course.